How do you measure financial feasibility for a food business? Imagine you're thinking about opening a new restaurant or food stall. How do you know if it will make enough money to stay afloat? That's where measuring financial feasibility comes in. It's like doing a financial checkup to see if your idea can turn into a profitable venture. First, you need to list all the costs involved. Think about the initial expenses like buying kitchen equipment, renovating the space, and getting all the necessary licenses. These are called capital expenditures. Then, consider startup costs such as purchasing inventory, marketing your launch, and hiring staff. Operating costs are ongoing, including rent, utilities, wages, food supplies, and other overheads. Next, you want to estimate how much money your business will make. This involves forecasting sales based on realistic assumptions. You can do this by looking at the market size and your expected share, or by calculating expected sales per day or per customer. For example, if you plan to serve 50 customers a day at $10 each, that's about $500 daily. Once you have your costs and revenue estimates, you can calculate key financial metrics. The gross profit margin shows how much profit you make after subtracting the cost of goods sold. If your menu costs are low and prices are high, this percentage will be higher. The net profit margin tells you how much of your total sales are left after all expenses. Knowing your break-even point is essential. This is the sales level where your total revenue equals your total costs. If your break-even is at $2,000 a day, you need to make at least that much to avoid losing money. Return on investment measures how much profit you get compared to what you invested. If you put in $10,000 and make $5,000 profit, your ROI is 50%. Cash flow projections are also vital. These are monthly estimates of how money flows in and out. They help you see if you can cover your bills, especially during slow sales periods. A detailed financial feasibility study includes multi-year projections of income statements, balance sheets, and cash flow statements. It also looks at working capital needs, tax implications, and possible risks through scenario analysis. This process reveals how much funding you need, when you might break even, and whether the expected profits justify the risks. Many food ventures face initial losses as sales grow, so tracking food costs, labor costs, and prime costs helps keep your margins healthy. In the end, your food business is financially feasible when your projected sales cover all costs, you can survive initial losses, and investors see a reasonable return. This careful planning turns your food idea into a realistic and sustainable business opportunity.